So, in the first quarter of 2026, Fifth Third Bank basically swallowed one of its biggest competitors.
Right, Comerica.
Yeah, Comerica. They absorbed over $50 billion in new loans, and somehow they still managed to convince their customers to accept lower interest rates on their savings.
Which is pretty wild when you think about it.
It really is. So, welcome to today's deep dive. We are looking at a really fascinating snapshot of the U.S. banking sector from April 17th, 2026. Specifically, we're tearing apart Fifth Third Bancorp's Q1 earnings presentation.
And, our goal here isn't just to throw a bunch of numbers at you.
Exactly.
It's about decoding how a major regional bank successfully digests a massive merger while navigating a pretty complex economic landscape. Because what's fascinating here is that banking isn't just about money.
Right.
It's really a reflection of consumer confidence and, well, corporate strategy. Normally, when a bank tries to swallow a whale like Comerica, you see chaos.
Total indigestion.
Yeah,
Right.
exactly. You see deposit flight, you see ballooning integration costs, and just a massive clash of corporate cultures.
But the deck we're looking at today paints a totally different picture. Fifth Third is showing what they call intentional selectivity in lending. They're growing organically, and they're keeping their expenses incredibly disciplined. So, okay, let's unpack this.
Let's do it.
I want to start with the headline numbers because they are striking. Adjusted earnings per share, or EPS, hit 83 cents. Tangible book value per share actually increased by 15%.
Yeah, that 15% jump is huge.
It is. But the real star of the show, I think, is the net interest margin. The NIM expanded by 17 basis points sequentially, hitting 3.30%.
Which, that is an incredibly aggressive margin expansion for a single quarter.
Right, especially during a merger.
Exactly, because net interest margin is basically the core spread of a bank. It's what they earn in interest on their loans minus what they pay out to you on your deposits.
So expanding that while duct taping two giant banks together is impressive. But wait, I have to push back here for a second. They absorbed Comerica's massive balance sheet, right? That's an extra $46.5 billion in commercial loans and $4.1 billion in consumer loans almost overnight.
Yeah, it's a huge addition.
So how on earth did their capital ratio, their CET1, land at exactly 10.0%? And honestly, didn't their expenses just go completely through the roof to make this happen?
Okay, those are two distinct, really good questions. Let's start with the capital ratio, the CET1.
Yeah, because we hear that thrown around in the financial news all the time.
Right. Think of CET1 as the bank's ultimate emergency fund. It stands for Common Equity Tier 1. It's the highest quality capital they hold measured against the risk of everything they own.
The risk-weighted assets.
Exactly. The denominator is key here. If a bank holds $1 million in U.S. Treasuries, that requires way less of a capital buffer than $1 million in, say, commercial real estate.
Because the real estate loan is way more likely to go bad.
You got it. So by landing at exactly 10.0% immediately after bolting on over $50 billion in new loans, they're signaling to Wall Street that they modeled this perfectly. Yeah, they didn't over-leverage themselves. They maintained that top-tier shock absorber exactly in line with their expected acquisition impact.
Okay, but what about the expenses? Because I'm looking at this sheet, and adjusted non-interest expense was $1.77 billion for the quarter.
Which looks scary.
It's a 39% spike from the prior quarter. It looks like they are just burning cash to force these two systems together.
It does look alarming until you really dig into the footnotes. So of that $1.77 billion, $635 million is specifically flagged as merger-related expenses.
Okay, so what are they actually buying with that $635 million?
Well, when two banks merge, you have redundancies literally everywhere. You're paying severance packages, you're paying penalties to break long-term vendor contracts early.
Because you don't need two separate software systems.
Right, exactly. And there are massive IT costs to migrate millions of Comerica accounts over to Fifth Third's core system.
What's that?
But here is the brilliant part of their strategy.
What's that?
That $635 million represents about half of their expected merger charges for the entire year.
Wait, really? Half of it in one quarter?
Yes. They are choosing to rip the Band-Aid off early. By paying the cost to break contracts and consolidate right now, they accelerate the timeline to actually realize the operational savings.
Ah, okay, so they are paying the demolition crew up front so they can live in the new house faster.
That is a perfect way to look at it.
Eh.
They explicitly noted the integration is tracking exactly in line with their expectations.
That makes a lot of sense. But that brings up a pretty big logistical hurdle. You can't just fund an extra $50 billion in loans out of thin air.
No, you definitely cannot.
You need a massive pool of cash, which leads us to exactly how Fifth Third is fueling this newly expanded machine, which is deposits.
The liability side of the balance sheet. And honestly, this is where their biggest strategic advantage really shines through.
Let's run through the numbers for the listeners because average deposits are sitting at a staggering $209.4 billion.
It is massive.
But it's not just the total size, it's where that money comes from. The mix is key here. So 27% is in demand deposits, 32% in interest checking, 34% in money market and savings, and only 7% is in time deposits.
Right, time deposits being things like CDs.
Exactly. So why does that specific mix matter so much?
Because that 7% metric is a huge victory. Look, in a tough rate environment, a lot of regional banks panic. They start offering, 5 or 6% yields on CDs just to keep people from moving their money.
Yeah, which is incredibly expensive funding for the bank.
Right, it's hot money. But because Fifth Third only relies on CDs for 7% of their funding, they are basically insulating themselves. And the ultimate proof of this is their overall deposit costs.
Yeah, I saw this and almost didn't believe it.
It's crazy. Total interest-bearing deposit costs actually fell to 2.15%. That's down from 2.28% in Q4 of 2025.
So they bought a massive competitor, grew their total deposits, and somehow paid less interest to the customers.
Exactly. Managing to lower the cost of deposits while retaining them is basically the holy grail of regional banking right now.
But how? I mean, think about your own banking habits. How do you convince a customer to accept a lower interest rate without them just hopping over to an online bank offering like 4%?
You build a digital moat.
A digital front door.
Yes. The friction of moving your money isn't about driving to a different branch anymore. It's digital friction.
Right. And the metrics here are wild. They have 3.25 million average active digital users, and a whopping 34% of their new consumer deposit accounts are now opened entirely digitally.
Without a human employee ever touching it.
Exactly. And it's not just that they have an app. A lot of banks have apps. But Fifth Third built the J.D. Power #1 ranked banking mobile app for regional banks. It's got a 4.8-star average rating. If your bill pay is totally automated and the app never crashes, the psychological barrier to switching banks just to get a fraction of a percent more in interest is huge.
It really is. And from the bank's perspective, that digital channel slashes their customer acquisition costs. They don't have to build a physical branch or hire tellers to bring that money in.
So they have this fuel tank that is completely full of cheap deposits.
Right.
The logical next step, the temptation, is to take that cheap money and lend it out recklessly to make a quick buck.
Right.
Go chase high yields.
That's the trap a lot of banks fall into.
But here's where it gets really interesting, because the data suggests Fifth Third is doing the exact opposite. They are practicing what they call intentional selectivity.
Yeah, they are basically mastering the art of saying no.
Let's look at the credit quality. Net charge-offs, which are the loans they legally have to just write off as total losses, are at just 37 basis points.
Which is incredibly low.
It's the lowest level in over 2 years. And their non-performing loans, the NPL ratio, actually dropped to 0.54%.
It is a remarkably clean portfolio.
Okay, but I have to play devil's advocate here.
Go for it.
Every financial news headline right now is screaming about the shadow banking bogeyman.
Oh, sure. Non-depository financial institutions.
Yeah.
NDFIs.
Exactly. Private equity funds, highly leveraged corporate loans. Are you telling me Fifth Third is just completely immune to this?
No, they aren't immune. But this is where the intentional selectivity really kicks in. They do lend to NDFIs, but it's heavily mitigated. Their entire NDFI portfolio is only about 7% of their loans.
Which is like $13.1 billion, right?
Right. And even better, 89% of that is rated investment grade.
Wow.
And here's the kicker. They have had 0 losses in the last 10 years across their core NDFI sectors: real estate, subscription lines, and private capital warehouse.
Wait, 0 losses in a decade? How is that even mathematically possible? Especially with things like subscription lines. Honestly, what even is a subscription line?
It's basically a highly specialized loan to a private equity fund. But the key is what the bank uses as collateral.
Okay.
Fifth Third isn't lending against the risky startup that the private equity fund wants to buy. They are lending against the legally binding capital commitments of the fund's investors.
Oh, interesting. So like state pension funds or university endowments?
Exactly. These massive institutional players have legally promised to give the fund money. The bank just provides a short-term line of credit secured by that absolute legal obligation.
So the collateral is basically ironclad.
Ironclad. That's why they haven't lost a single dollar on them in 10 years.
That makes so much sense. And what about leveraged lending? The loans that load companies up with a ton of debt.
They've been crushing that down too. Leverage lending is down to roughly 2% of their total loans.
Wow.
Yeah, back in 2015, it was around 8%.
Yeah.
So they have deliberately stepped away from that risk.
Okay, but what about the shared national credit portfolio? That makes up 26% of their total loans. Isn't that just buying blind slices of giant corporate debt syndicates?
That's the common perception, but no. Fifth Third acts as the lead left or lead right bank on roughly half of those relationships.
Meaning they are actually writing the rules for the loan.
Exactly. They set the covenants, they dictate the underwriting. Because they control the terms, their shared national credit book actually has fewer criticized assets than the rest of their commercial portfolio.
That is wild. Okay, so this brings up a massive logical dilemma to me.
How so?
If Fifth Third is playing at this incredibly safe, no leveraged loans, super secure NDFIs, low charge-offs, they must be leaving a ton of loan interest money on the table. You just can't charge 15% interest on a perfectly safe investment-grade loan.
No, you definitely can't.
So how are they generating enough revenue to keep Wall Street happy?
That is the big question. And the answer is their shock absorber. Non-interest income. Fees.
Okay, let's use a restaurant analogy for this, because I love a good analogy.
Sure, go ahead.
If interest income is the revenue from selling the steak, non-interest income is the money you make selling the branded cookbooks, the private cooking classes, and the bottled sauce at the register.
Exactly. You are monetizing the customer relationship without taking on the risk of spoiling more expensive inventory.
Right. And their non-interest income was massive. Adjusted non-interest income was $921 million for the quarter.
Which is up 28% year over year. That is huge.
Nearly $1 billion in a single quarter without taking on credit risk. So what exactly is driving that fee income?
It's a really diversified mix. Wealth and asset management revenues spiked 35% year over year.
Wow.
Commercial payments jumped 42%. And capital markets fees soared 49%.
That raises an important question, though. How does that position them against their peers? Are other banks doing this too?
Not to this extent. Fifth Third's fee revenue accounts for about 33% of their total pro forma revenue.
Okay.
The peer median is just 29%.
That 4% gap is massive.
It really is. It acts as a powerful shock absorber against economic cycles. If loan demand dries up, they still have a third of their revenue churning out cash every day from fees.
And just to prove this isn't some one-off fluke from the merger, looking at their full year 2026 guidance, they are projecting net interest income of $8.7 to $8.8 billion. But they expect non-interest income to be between $4.0 and $4.2 billion. So they are maintaining that strong, diversified revenue engine.
They absolutely are. It's a permanent structural shift for them.
So what does this all mean for you, the listener? Fifth Third Bancorp in Q1 2026 is essentially a masterclass in controlled expansion.
Yeah, that's a great way to put it.
They successfully absorbed a massive competitor in Comerica. They leveraged a top-tier digital experience to grow deposits cheaply. They strictly avoided reckless lending. And they leaned heavily on wealth management and commercial fees to drive revenue.
And really, whether you're running a tech startup or just managing your own personal portfolio, there's a profound lesson here in intentional selectivity.
Absolutely.
Growth shouldn't come at the expense of lowering your standards. You can double your footprint, digest a huge competitor, and still improve the fundamental quality of your business if you maintain absolute discipline.
It's incredibly hard to do, but they proved it's possible. Now, before we wrap up, I want to leave you with a final thought to ponder, something we didn't really touch on, but that builds directly on this strategy.
Oh, this should be interesting.
We talked a lot about that 33% fee income shock absorber, right? Largely driven by wealth management.
Right.
And we also talked about how they've trained their customers to rely entirely on their 4.8-star mobile app.
You have a digital front door.
Exactly. Well, with artificial intelligence advancing as rapidly as it is by 2026, how long will it be before traditional fee income like human-led wealth management is entirely disrupted?
Oh, wow.
Think about it. What happens when highly personalized AI financial advisors are just natively built right into that exact same highly rated mobile app?
Offering institutional-grade management for free.
Exactly. Will the very digital moat they built to lower their deposit costs eventually cannibalize their most lucrative source of non-interest income?
That is a fascinating tension to think about.
It really is the kind of stuff that makes diving into these strategies so fun. Anyway, that is all for today. Thanks so much for joining us on this deep dive, and we'll catch you next time.